Hello and welcome to another episode of Darwin Investors. Early retirement, the holy grail. Can I do it? How much would it cost to retire early? And is it even possible? These are the things I hope to try and answer by the end of this here video. So yeah, let me go ahead and get started here, share my screen. So a lot of people, if they were given, say, especially if they're younger, not people that watch this channel that are not financially savvy, but people that are not financially savvy, if you give them, say, $5 million and that's the average 30-year-old, they'll have that spent in about a year, right? They'll buy a house, a car, they'll party with their friends, and they'll be out of money in no time. Now we get a little bit older, and you're still not very financially savvy. So you hand somebody $1 million and they say, well, I'm going to spend $100,000 a year. How long will that last? And most people say, well, that would last 10 years. But I understand the people that watch this know that that's not exactly true, that you can actually invest it and stretch that out quite a bit, maybe even indefinitely. So when Fidelity talks about here, how much do I need to retire? They'll say, well, you got to save 10x your income by the time you turn 67 years old. And that doesn't mean that they're putting you in the ground at 77 years old. They're just saying save that much and you can make that last a very long time. But these things are going to be dependent on your personal savings goals, the age you plan to retire, and the lifestyle that you hope to have in retirement. I would say of these, the age that you plan to retire is not that important given the strategies I'm about to show you in this video. But your personal savings goal is important, and the lifestyle that you plan to hope to live in retirement is important as well. I think most of us want to live the same exact life that we have right now. Nobody wants to retire and suddenly live a less life. Like, we're not going to move off of the golf course and into some place that's less desirable. And so what we're going to do is we're going to go over a few things here today. What I'm going to do is I'm going to talk about some of what I call retirement ETFs. So it'd be QYLD, QYLD, JEPI, NUSI, and QYLG. I'm going to go into depth on these two a little bit. I'm going to glaze over the top on these two. We're going to compare them to the S&P 500 to see what kind of investments these are in retirement versus this one here. We're going to also going to compare these ETFs to traditional dividend stocks. They would be like your utilities and your REITs or something like that. Like the two I'm going to look at are going to be Verizon and Simon Property Group. We're going to compare these dividend stocks to just to holding on to great companies. And when I mean great companies, I'm talking about the ones that have to go before Congress and apologize for all the money that they're making. I'm talking about those companies, the ones that we know that are great. Okay, and so I'm going to compare them to these holding these companies, and I'm going to tell you what I'm doing in the stock market now and what I plan to do in the future in retirement. All right, so the first stock on the agenda today is going to be QYLD. It's a NASDAQ 100 covered call ETF. And I know that's a mouthful, but I want us to understand what we own here. So let me go ahead and just go over what a covered call is really quickly. So a covered call would be a way that I would use to generate small gains against my underlying stock. And so for covered calls, they have a date that expires. In this case, it's April 8th. Today, it's March 26th. We have a strike price, which would be in this case $130, and we have a premium, which is $1.33 a share. Every single contract holds 100 shares, so it gets you $133. And what this contract says is that I am agreeing to sell AMD at $130 a share by April 8th if it should finish over that. So let's say it's $135, I'm still going to sell it to this buyer at $130 a share, and I'm going to sell them 100. For this contract, somebody's going to pay me $133 to hold this for them. If on the 8th of April, AMD is trading at $125 a share, I will keep my 100 shares of AMD and their money. And that is a covered call. And so QYLD is a covered call ETF of the NASDAQ 100, an ETF being a collection of holdings in one stock. and like a mutual fund. And this is over the NASDAQ 100. So when we look at their holdings down here, they hold the NASDAQ 100 stocks. And on each of these, they are trading covered calls on them. And so they're not, it doesn't appear to be trading covered calls on the triple Qs on the NASDAQ 100. Actually, the actual triple Qs, they seem to only have these holdings here. And they're trading covered calls on that, just like I did with AMD. And on top of that, they own the stock. And should some of these stocks give dividends, they'll also get a small dividend with that stock as well. So this stock here has a annual yield of 11.13%. And that's because they're a covered call ETF. They hold a bunch of stock and you're paying money. They're trading covered calls for you. They're taking on the risk. Now, because they're taking on the risk, and covered calls are not, it's not like sure money. You know, you sometimes win, you sometimes lose. So they're taking the risk for you. And sometimes sometimes they win, and sometimes their stock is $22 and sometimes it's $21 or whatever. But in retirement, we don't really care. All we care about is this yield. So let's say, for the sake of argument, you retire on $750,000. So you have that saved up. And you're making this yield here of 11.13% times 0.1113. That would mean that annually you're bringing in $83,475 or $6,956 a month. Now, if this is the sort of thing that you can live off of, then I would say then all you need is $750,000 to retire. And this will happen forever. So that's why I said the age you plan to retire is not that important. I guess it is to some degree, considering inflation and that sort of thing. And if this is all you're going to live off of and you're never going to work another little part-time job and get that, or if you're going to spend every nickel of this and not put any of it away or not reinvest back into QYLD or something else, then yeah, I guess it matters. But this one here with $750,000 will give you $6,956 a month. It's paid monthly. You can see here that they give you 20 cents, roughly 20 cents a share. Let me give you a good one here. This was a special dividend at Christmas, 50 cents a share. Right across here, they give you 23 cents in February, 22 in March, 23 in April, and 22 in May. The way that works out is that basically it's $20.87 a share. So if you had $750,000, you divide that by $20.87. That will equal 35,936 shares. And a lot of this, it looks like, let's just call it times 20 cents a share, times 0.20. And now you've got $7,187, which is, I guess, a little bit better than the 6,900 or so odd that I said you could have about that. Now, why is this just a retirement only stock? Well, it's because the stock itself over the course of the year loses 6.91%. And the annual dividend is only 11%. So you can see over the year you would end up making money. However, there are better investments out there, but I would argue that there's not too many better investments in your retirement age if you're just looking to just collect dividends. One that might be considered better, and the one that I really, really love, and it's actually my favorite of the bunch, is this one right here. And it's similar. It's also a covered call ETF, but JP Morgan put this out. It was their answer to QYLD. QYLD is wildly popular. JPI is very interesting to me because they actually grow. This stock actually grows if you look at it. It's only been around for a few years, but you can see it actually goes up in value. Unlike QYLD, which basically trades sideways. If you look at it over the course of its lifetime, it's been around since 2013. It started off in this year just under $24, like $23.80 or something like that, and it's currently sitting at $20. During huge downturns, it doesn't go down much. When the bulls are running, it doesn't go up much. But JPI is a little bit of a different story. JPI actually does appreciate. And it gives you 5.1% annual return. And it gives you a dividend paid monthly, just like QYLD, of 7.16%. So let's go ahead and roll some math on JEPI, and I'm going to show you why I like this one so much. So with JEPI, you probably need a little bit more money to get started. Now, that's one of the advantages of QYLD. You don't need as much to get going. But if you have the money, this is the one that I would probably trend to go with. So let's say instead of 750,000, you have $1 million. You started saving early in your life and you were able to put away $1 million. So if you had $1 million and you multiply that by 0.0716, you'll see that you have $71,600 a year. Now that's not as much a month. If you divide that by 12, that's $5,966 a month. Now that's not as much as $750,000 in QYLD. So why do I like this one so much? Well, if you should start off with a little bit more money, let's say you start off with $1 million and you multiply that by 5.11%, 1.0511, you now have $1,051,100. You just made $51,100 that year. And then you take that number and you multiply that by 0.0716. Now you're making $75,000 a year. So your income goes up every single year. If you divide that by 12, you're suddenly now making $6,200 a year, and so on. And you give this stock a few years, and you're suddenly going to be making more than you were with QYLD. But you have to be a little bit patient. You got to give it about, I'd say, about 4 years, and all of a sudden you're going to start making money. And from that day forward, you're going to make more than you ever made on QYLD. That's why I love JEPI for retirement. What does JEPI hold? How are they able to do this? Well, they're, like I said, they're also a covered call ETF. They hold contracts, covered calls on the S&P 500, but they also hold a lot of high dividend companies, not just like the NASDAQ 100 companies that don't pay a great dividend that say QYLD holds, but rather they hold AbbVie, and they hold energy companies, and they hold pharmaceutical companies and financial companies and all kinds of stuff. Now they also hold some NASDAQ, they hold Microsoft, they hold Google. Now O'Reilly's NASDAQ, they hold O'Reilly, but they're able to generate dividends from their holdings because they have large dividend holdings, and they're able to generate returns on their covered call on the S&P 500. Now, QYLD wasn't going to take this one sitting down, so they created QYLG. And QYLG was their attempt at trying to get growth out of a covered call ETF. So the knock on them is you don't want to invest in QYLD until you retire. And so they said, well, we're going to grow. Okay, so we're going to do one that grows. And you can see that it hasn't been growing because it's been a bad year, but they've lost, well, they're even for the year. And they pay a much smaller dividend, not the 11%, but this one pays 5.37%. And the way they're trying to do it is, this would be actually really good in a bull market. Let's say that we're really running strong. Then this one's going to go bonkers. You're going to get your 5%, and you're also going to get a lot of returns on these kind of speculative companies. So you see they hold DocuSign, they hold Zoom, they hold Okta, they hold Splunk. So some of these in a bull market are going to run wild. And so what they're saying is that we're going to sell covered calls on a lot of things, but we're also but half of our portfolio is going to be high growth. And so in a bull market, this thing is gonna take off, but that's not the case at the moment. So this might be one I'd probably steer clear of for the time being, for sure. NUSI, this is nationwide. They were also wanted to do a NASDAQ 100 covered call ETF. And so they're doing the same thing as QYLD, and they hold all the same stocks, doing all the same thing, and they're giving you 8.68% paid out monthly. So Again, this is not one I would go for, not one I would go for, certainly not in a bear market. JEPI is great if you've got a lot of money, and QYLD is great if you just want the most money now and you're starting off with a little bit less. All of these things will compare to the S&P 500. So are these the sorts of things that you want to invest in now? Well, if you look at the S&P 500, the S&P 500 had an annual return of 14. If you just invest in the SPY, that would be an ETF through the SPDR. So the S&P 500 ETF through SPDR gave you a 14.38% return last year, and a 1.31% dividend yield for a total of 15.69%. Now that's better than, say, JEPI, which gave you 5.11 plus 7.16. It's 12. But remember, this is giving you 7% of this is your dividends, whereas in the S&P only 1.3% was dividends. You can live off of this one with enough money. It's going to be very difficult to live off the other. So this would be one that might be good if you're trying to grow your portfolio pre-retirement, but not one that I would recommend to probably live off of, or at least not one that I'm going to live off of when I decide to retire. Now, how do these compare to ordinary dividend stocks? Verizon would be a popular dividend stock. Verizon will pay you, this one's particularly bad, it appears, because it lost 12.83% last year, and it looks like its dividend is 4.99%. So it only made you 5% last year in dividends, and it lost 12% in the underlying. So what would Verizon pay you at 4.99%? So let's say that you had $750,000 and you plan on retiring off of Verizon, 750,000 times 0.04999, and that equals to $37,492 a year, or $3,124 a month. Slightly better than them is going to be Simon Property Group. Simon Property Group did appreciate last year, 14.37%. It appears the malls are raging, folks. You didn't know it, but they are apparently. So Simon Property Group grew last year for 14.37%. They pay a dividend of 5%, so they're going to pay you roughly the same as Verizon. You're going to get your $3,100, $3,200 a month, but you're also going to get this appreciation. So all told, this one actually grew last year, 5% plus 14%, that's 19.37. And the S&P last year grew, what did we say, 15%? Yeah, 14.38 plus that. So 15. So Simon Property would have been a better investment last year, it appears, than just owning the SPY. So that'd be, but again, if you're looking for it as something that's going to give you a monthly dividend in your retirement, this is probably not the one I would go with. I would go again with QYLD, or I would go with JEPI if I had more money. Now, how do these compare with just owning great stocks? And so if you look at this stock now over 5 years, Apple, you'd have gone up 386%. If you went with Microsoft, you would have gone up 361%. If you go up the S&P 500 over 5 years, you would have gone up 92%. So note, again, as a benchmark, S&P 500, 92% 5 years, Apple, 386%, Microsoft, 361%, Google went up 241%, Amazon went up 271%, Lowe's went up 159%. So I would argue, and there's nothing wrong with investing in the S&P 500. There's nothing wrong with that. But provided you don't get too creative, I would argue that given enough time, it's better just to pick a few super high quality stocks like these. And this is what I'm doing right now. Just pick a few super high quality stocks, sell covered calls against your underlying, and generate the dividends they pay you, plus a little bit of your own personally manufactured dividends through the sale of covered calls, and wait these things out, because you're going to get a better return than the S&P. And then once I retire, I'm going to switch over here. In all likelihood, probably I'm going to switch over to the JEPI. That's the one I'm going to actually get into. But I wouldn't blame somebody for switching into QYLD. Like if you're trying to retire a little bit earlier, you got a little bit less money, and you want to get it going right now, this is not a bad option either. All right. That does it, folks. If you got anything out of this video, yeah, please like, subscribe, hit that little notification bell. Until next time, we'll see you then. Bye.